So question number 40, it was a homework. Now balance sheet has been given, calculate interest and then interest on capital, and you have to first find out what is the balance, correct? So in rough you must have prepared the capital accounts for both the partners, that is Sujata and Swati, correct? So capital account for both the partners. Now so we are given closing balance 90,000 and 80,000. So to balance brought down, closing balance, to balance carried down, 90,000 and 80,000, right? Sujata and Swati, we are given that. Then what else is given? We are given workman compensation reserve. Okay, so this was a workman compensation reserve which was set aside this year. Then during the year the drawings of Sujata and Swati were 10,000 and 30,000 respectively. So drawings have a debit balance, so you transfer it to capital. So entry will be partners capital account debit to partners drawing. So Sujata is 10,000, Swati is 30,000, correct? Now profit during the year is 60,000. So let us transfer this profit during the year to P&L appropriation. So P&L account profit, so it will come on the credit side. Then this workman compensation, this is the workman compensation reserve was set aside during the year ended 31st March. So this 40,000 workman compensation reserve was created in that year. So the entry would have been P&L appropriation account debit to workman compensation reserve. Reserve account, correct? And entire 40,000 is created in this year. So 40,000, and then the balance profit. What is the balance profit here? Credit side is 60,000 minus 40,000. So your balance profit is 20,000. This 20,000 will be distributed to partners in their profit sharing ratio. Let us see what is their profit sharing ratio. Okay, nothing is given, so profit sharing ratio is equal, okay, to profit distributed to partners capital, correct? So you have Sujata and Swati and 10,000, 10,000, correct? Now this is profit. So profit means it will come on the credit side of the partner's capital, correct? The entry was P&L appropriation account debit to Sujata's capital to Swati's capital. So it will come on the credit side. By profit and loss appropriation account, how much is that? 10,000, 10,000. So now let us find out what is the opening balance over here. Correct, because we need opening balance to calculate interest on capital. So Sujata total is 1 lakh minus 10,000. So you get by balance brought down. This is a balancing figure, 90,000, and then this is how much? 1,10,000. So 1,10,000 minus 10,000, you have 1 lakh. Now you have to calculate interest on capital on this. Okay, so let me calculate. So interest on capital, okay, Sujata's balance is 90,000. So 90,000 into how much is the percentage? 5%. So 5 by 100, and Swati will be 1 lakh into 5 by 100. Did you calculate this in this way? Any errors here? Okay, so you got it correctly. Okay, go to page number 1.41. Go to page number 1.41. Now in this what we are learning, if the appropriations are greater than the available profit, then what we are going to do. So we learned two cases. So if there is a loss, then there is no point, there is no logic in giving partner's salary, interest on capital and then distributing that entire loss. We must never do that. If there is a loss, you deduct interest on drawings and then whatever is the net loss after deducting interest on drawings, that should be distributed to partners in their profit sharing ratio. That is what we have done it here. Now let's say if after deducting interest on drawings, okay, you get a excess, then that excess, whatever excess is available, use that to proportionately pay whatever expenses are there, like interest on capital, partner's salary, partner's commission. So what we will do is we will calculate how much is the total, okay, of interest on capital, partner's salary, partner's commission. Then we will calculate the proportion of each component, that is interest on capital to this total, partner's commission to this total, partner's salary to this total, and then we will allocate this excess available, okay, in that particular ratio. That is nothing but that is known as a ratio of appropriation. Same thing we have done it here. So 1 lakh was excess. So what we have done, that 1 lakh is not sufficient to pay your interest on capital and annual salary of the partner. So what we did is we calculated what is the ratio between interest on capital and partner's salary. Okay, so that came to, so this was 1 lakh is to 2,40,000, so that came to 5 is to 12. Then using this ratio, we have distributed this 1 lakh between interest on capital and partner's salary, and then again use the same logic. See what is the ratio of interest on capital within the partners. Okay, so and X and Y interest on capital was 50,000, 50,000. So ratio was 1:1. So whatever interest on capital is calculated over here, that is 29,412, is distributed equally among the partners. Now for partner's salary, see what is the initial ratio. So it was 1,40,000 is to 1 lakh. So 14 is to 10, so that is 7 is to 5. So accordingly use this ratio and distribute the total partner's salary, okay, to your individual partner. So this is what is known as ratio of appropriation. So is this clear or you have some doubt in this? Don't get confused. So this will be applicable only when you don't have sufficient profits to give everything, that is interest on capital, partner's salary, partner's commission. Okay, so you will be using that available profit in that particular ratio, which is very, very logical. Correct? Now let's go to example number 13. Okay, now see here, net profit is 5 lakh, interest on capital is 1,80,000 for Y, and interest on capital for X is 1,80,000 and Y is 1,40,000. Then partner's salary, X is 1 lakh, Y is 3 lakh. Now if you calculate this, 3 lakh plus 1 lakh, partner's salary itself is 4 lakhs. Okay, and interest on capital 1,80,000 plus 1,40,000. Okay, if you add it to this 4 lakhs, definitely it's going to be more than 5 lakh rupees. So again in this case we are having the net profit which is available of 5 lakh rupees is not sufficient to cover your interest on capital and partner's salary. So again in this case what we will do is we will be using ratio of appropriation. So let us calculate that. Okay, so by P&L account, so this is a net profit of 5 lakhs. Okay, now let us calculate the ratio. Now what is the total interest on capital? Total interest on capital is 1 lakh, correct? It was given in the question, right? How much is that? Interest on capital is 1,80,000 plus 1,40,000. Okay, so that comes to 3,20,000, correct? And then partner's salary, how much is partner's salary? partner's salary is 1 lakh for X and 3 lakhs for Y. So that comes to 4 lakhs. So if you see here, 4 lakhs and 3,20,000 both are greater than 5 lakhs, correct? So available profit, how much is the available profit over here? Available profit is 5 lakhs. Okay, so now what we are going to do, we are going to calculate ratio of appropriation between interest on capital and partner's salary, because available profit is less than the appropriation. So here if you see, this is 3,20,000 is to 4 lakh, correct? So this comes to 4:5, correct? Now use this ratio to calculate interest on capital. So here interest on capital will be available profit, that is 5 lakh into 4/9. Okay, calculate that, and then once you calculate this, we leave some lines because we are going to calculate ratio to each partners also over here. Then what you do, in next page calculate what is the, how much is the partner's salary, 1.44, page number 1.44, you can calculate how much is the partner's salary. Partner's salary will be how much? See, this is 5/9, correct? So partner's salary will be, this is 4/9, so partner's salary will be 5/9 into 5 lakh. Yeah, calculate this. So this comes to 2,22,222 and your partner's salary is how much? 5/9 into 5 lakh. So you get 2,77,778. So you are getting it in decimals. So just round it off. Okay, round it off. Now within interest on capital, we will find out how much should be given to A and how much should be given to B. So A was given interest on capital of 1,80,000. How much should be given to X? I am sorry, X and Y are partners, right? So X was given 1,80,000 and Y was supposed to be given 1,40,000. So now we will calculate what is their ratio. Okay, so how much is their ratio? 1,80,000 is to 1,40,000. So how much do you get? 9:7. So this 2,22,000 we will be distributing it between X and Y. Correct? X and Y in the ratio of 9:7. Into 9/16 and Y will be 7/16. Okay. So this comes to 1,25,000 and this comes to 97,222. Okay. Now let us calculate it for this one, partner's salary. So partner's salary was how much initially? Partner's salary, X salary was 1 lakh and Y's was 3 lakh. Correct? So total partner's salary was 4 lakh. So what is the ratio of partner's salary? 1:3. So X will get 2,77,778 into 1/4 and Y will get 2,77,778 into 3/4. Okay. So X will get 69,444 and Y will get 2,08,000 334. Okay, so same thing we are going to use it in our profit and loss account. Same workings, whatever we have done, we will be using in profit and loss account. So 2, interest on capital, X and Y. How much is the interest on capital for X and Y? How much did we calculate? 1,25,000 and 97,222. So total comes to 2,22,222. And to partner's salary. So since you don't have calci, no, they may give you some easy amounts to calculate. It won't be much in decimals. Sometimes it can be, sometimes it won't be in decimals. Okay, it will be easy calculation. Okay, so after doing this, your total should be 5 lakhs because you have used this 5 lakhs to divide between interest on capital and partner's salary, and then in between X and Y. Okay, let me know once you are done. Question number 30 in your textbook. A and B were partners in the firm, sharing profits in the ratio of 5:3. Their fixed capital on 31st March 2017 were A 60,000, B 80,000. They agreed to allow interest on capital at 12% per annum. Okay, so interest on capital that is allowed is 12% per annum. The profit of the firm for the year ended 31st March 2018 before allowing interest on capital was 12,600. So before allowing means before deducting interest on capital, the profit was 12,600. Pass the necessary journal entries for above transactions in the books of A and B. Also show your workings clearly. So we have to pass the necessary transactions. So what are we supposed to do here? See, profit before deducting interest on capital is given. Now from this, what we need to do? We need to calculate how much should be the interest on capital. We have to pass the entry for interest on capital, and then balance profit, whatever is the balance profit, that we need to distribute it among the partners. Okay, so prepare a journal entry format for around 12 to 15 lines. So journal entries in the books of A and B. Okay. Shall we start? We will calculate how much is the interest on capital first. Okay. So let us write working note number 1, interest on capital. So you have two partners, A and B. So how much is the interest on capital of A? Let us calculate. So 60,000 and 80,000 are the balances and 12% is the interest. Okay, so their fixed capital on 31st March 2017 are 60,000 and 80,000. So that means on 1st April 2017 also their capital balances are 60,000 and 80,000, and we have to calculate the interest on capital for year 17-18. So opening balance is 60 and 80. Let us calculate. So 60,000 into 12 by 100, 80,000 into 12 by 100. So this comes to 7,200, correct? And this comes to 9,600. So how much is the total interest on capital? Total interest on capital is 16,800. Now see here. See, total interest on capital is 60,800, whereas Available profit is only 12,600. So available profit is less than the appropriation. So we have to use ratio of appropriation. Remember this. Okay. Always you have to check whether the profit is sufficient to cover that particular appropriation, that is interest on capital, then your partner's salary, partner's commission. Okay. So available profit is 12,600. Okay, so now we cannot give them total interest on capital of 16,800, correct, because available profit is 12,600. So now what we will do, we will calculate the ratio of appropriation. So now 12,000, now here we have only one thing, right? In whatever examples we have solved till now, we had 2-3 things like interest on capital, partner's salary, partner's commission. In that case, what you need to do, individually for each and every ledger account, that is interest on capital, partner's salary, partner's commission, each and every component you have to calculate ratio first, okay, proportionate amount, and then calculate the proportionate amount within the partners. But here, since we have only interest on capital, that means this available profit of 12,600 will be distributed as interest on capital to A and B. In what ratio? This will be distributed between A and B in the ratio of 7,200 is to 9,600. Did you understand this? Any doubts here?
No doubts, ma'am.
Sure, right? So if you reduce this will be 3:4. So now how much interest on capital to A will be how much? 12,600 into 3/7, correct? And B will be 12,600 into 4/7. Calculate this. How much does this come to? 5,400 and 7,200. So this will be our interest on capital entry. So done with the working. Now let us calculate this. Okay. So on 31st March 2018 we have to pass the entry. Okay. So entry will be, see, interest on capital has to be given to the partners. So interest on capital will be debited. So interest on capital account debit. How much is it? 12,600 to. Now remember, read the question properly. Their fixed capitals is 60 and 80. That means they are following fixed capital method. So this interest will be transferred to their current account, will be posted to their current account. See, you will lose the marks if you write capital account over here. Okay. So to A's current account, to B's current account, correct? And how much did we calculate? 5,400, 7,200, correct? We just did one working note now. B, interest on capital given to partners. Calculated as per, you can just give the reference, working note number 1. Now what we need to do, we need to transfer this interest on capital to profit and loss appropriation account. So on 31st March 18, now interest on capital has a debit balance, so it will go to profit and loss appropriation debit side. Profit and loss appropriation account debit, okay, 12,600 to interest on capital account 12,600. So being interest on capital transferred, Okay. Now, had there been some balance in the profit and loss appropriation, we would have distributed it to the partners in their profit sharing ratio. But here there is no balance. Your profit and loss appropriation net profit was 12,600. We have used that entire profit for interest on capital. So there is no profit left to distribute it to the partners. So there won't be any third journal entry. If there was a profit, there would have been one more entry for distribution of profit. Is this clear? Now see, with this we have ended one so basically this basics of partnership chapter has three main topics, I can say. So first was all the basics of partnership, wherein we learned how to calculate all the appropriations. Then what are the provisions of the Partnership Act if there is nothing mentioned in the partnership deed, or there is no partnership deed, or if there is some disagreement between the partners. Now once that is done, that was the first part. The second part that we are going to learn now is guarantee of profit. So go to page number 1.44, guarantee of profit. So this is the second part. If I want to divide this chapter broadly into three parts, first part is how to calculate basics, what is the definition of partnership, features of partnership, what are the appropriation, charge against profit, then what is how to calculate interest on capital, interest on drawings, then your partner's commission, partner's salary, all that was first part. Okay. Then second part is guarantee of the profit. This is the second major part that we are going to cover now. Okay. So let's start. Now you already know the meaning of word guarantee. So what is a guarantee? Whenever you take some anything from the market, if you buy some phone or anything, even shoes, anything, so they tell you that this has a guarantee of, let's say, 6 months or guarantee of 1 year. What does that mean? That means that for the minimum period, remember the word minimum period of 1 year, your particular phone or your shoes, okay, they will be working. Okay, so in case if they are not working, okay, or if for your shoes or something, if they are damaged or something like that, then what they will do is they will replace those shoes or replace those mobile phone. If you have a mobile phone, then they'll replace those. So what does the word guarantee means? Guarantee means that a minimum for the minimum period of so and so days, this thing will work. That is the guarantee from the side of manufacturer or a dealer. Okay. Now when it comes to partnership, there is a word guarantee of profit. Okay. So again I said guarantee means minimum. So here also guarantee is a minimum profit share to be given. So some partners will agree to join the firm. See, if a particular partner has some goodwill, and if that partnership firm wants to join him as a partner, then sometimes they may have to give this guarantee to the partner that you will be getting a minimum profit of so and so rupees. If that minimum profit, if in a particular year, if that partner doesn't get that minimum profit, then that minimum profit will be either given by some other partner or firm, depending on your terms and conditions. Did you understand the basic meaning of the word guarantee? Guarantee is the minimum profit guarantee given to any partner. Okay, and it will be mentioned in the deed. Okay, now let us see what are the three types of guarantee over here. So three types of guarantee are partner to firm, firm to partner, and partner to partner. So let us
basically so like guarantee to profit means that even if everything happens, you still get that profit.
Correct.
It's like confirmed.
Correct. Yes. So now.
Also, like what happens in case if like the company is going into loss?
What happens? What?
No, I was about to ask, in case of the company is in loss, what happens? It's
Ah,
already written to
we
the
will
point.
solve some examples. You will understand what happened. Still, you have to give guarantee. Still, you have to give whatever has been promised. You have to give it to the partner. We will solve some examples now. It will cover all
Won't
that.
that make the company's business go worse and worse?
Ah,
To get,
companies.
won't that make the like status of the business go like down?
Yeah, that is there. But
It's
then,
already
yeah, that is there. So risk is there. See,
negative.
risk is there. See, now listen here. Practically, nobody will give you a guarantee. Nobody will give you a guarantee unless there is some benefit to the firm. Okay. So let's say if there is a partner, okay, and he has some skills, for example, which are very beneficial to the firm. Okay, or if that partner has some goodwill which will be again beneficial to the firm. So in that case, to retain that particular partner, firm has to give some guarantee to the partner. Okay, of course whatever you are saying is correct. There is a risk. If the firm always incurs the loss, still firm has to pay that percentage of profit to the partner. Yes, that risk will be there. But that guarantee, see, firm will be signing that guarantee of profit only with the partner, only if it thinks that whatever benefits I am getting from the partner are worth that guarantee. Okay, there will be always a analysis, risk analysis. What is the risk? What are the benefits? Always. Now let us understand what we have already seen what is the guarantee. Now let us try to understand over here. A, B, C are partners. Their profit sharing ratio is 1:1:1. Okay. Now let's say C. C is given a guarantee. Okay, C is given a guarantee that his his share of profit will be 50,000 every year. Okay. Now, in a particular year-end profit of the firm was 1,20,000. Okay. Now this 1,20,000, if I distribute it among three partners, that is your A, B and C, each one of them will get how much? 1/3, that is 40,000. Okay. Now look at C. C's profit, guaranteed profit is 50,000, but he is getting 40,000. So there is a deficiency. So how will you calculate the deficiency over here? Deficiency is equal to your guaranteed profit minus actual profit. Okay, guaranteed profit minus actual profit. You can just highlight this formula. Now don't write, wait, I'll give you time to write. Okay, don't write. Now see here, now this deficiency, so let us calculate deficiency. So C's deficiency is how much? 50,000 minus 40,000. So 10,000 is the C's deficiency over here. Correct. Now the C's deficiency, there are two options now. Okay. This C's deficiency can be guaranteed by firm or it can be guaranteed by some other partner. Okay, so if the firm is guaranteeing this deficiency to the partner, then firm will pay this amount of deficiency to the partner. By the word firm here, I mean, this is important, remaining partners, not the entire firm. Okay, so here Who are the remaining partners over here? A and B. So A and B will give it to C. If some particular partner has given a guarantee, that guarantee is known as partner to partner guarantee. Now that if, let's say in that case, if A has given the guarantee, then A will pay this deficiency amount to C. Or if B had given the guarantee, then B would have paid it to C. Okay, so this is known as partner to partner. If the firm is giving, then it is known as firm to partner. Now apart from this, there is one more type. So this is first one type, second type and third type of guarantee. So what is third type of guarantee? Partner to firm. So in that case what happens? Partner and this is a firm. Okay, now partner, a particular partner is saying that I will be earning a profit of some amount, let's say 1 lakh rupees in a particular year for the firm. Okay, but that particular partner was able to earn or able to bring the business which could result in the profit of 80,000 rupees. So this deficiency, okay, deficiency of 20,000 will be paid by partner to firm. Did you understand this? Now let us just go through all these points whatever we have written over here. So there are basically three types of guarantees we have discussed: partner to firm, firm to partner, partner to partner. Now guarantee is fulfilled by partners in the agreed ratio. This is when the firm has given the guarantee to the partner. Then firm means what? Remaining partners. Here firm means remaining partners. So this remaining partners will fulfill this guarantee, okay, in the agreed ratio, or if agreed ratio is not given, then in profit sharing ratio. Okay, profit sharing ratio among themselves. Profit sharing ratio among remaining partners. This is important. Okay. Then, in case of multiple guarantees in single question, we must follow the order of guarantee as mentioned in point 2. So, if there are multiple guarantees, then there is a specific order which we need to follow. What is that order? First, we must see partner to firm guarantee. Then, second will be firm to partner. And third will be partner to partner. When we solve the question, we will see this. Okay. In case of loss, guarantee is still to be fulfilled. This is what we discussed, right? Even if there is a loss, we have to fulfill the guarantee. Guarantee of profit is generally calculated according to time. So, the guarantee of profit is calculated according to time. So, for each and every point, we have one example. We will solve it now. Okay. Did you write this? Okay. Now, let us start. Okay. So first guarantee that we will be learning is from partner to firm. That is, partner has given the guarantee to the firm. Let us read the question. So P and Q are the partners in the firm and their profit sharing ratio. PSR is for profit sharing ratio is 1:1. P gives the guarantee to the firm that minimum profit of the firm will be 15,000. So P has given the guarantee that minimum profit of the firm will be 15,000, but profit of the firm was 5,000. Okay, solve it by preparing profit and loss appropriation account. So now see here, there are two types of accounting methods when we talk about guarantee. We will be learning about both the methods, but first let us see the calculation. So what has happened over here? This is P and firm. Okay, don't write anything. So P has given the guarantee. Okay, what is the guarantee? Guarantee that the firm's profit will be 15,000, but actual profit of the firm was only rupees 5,000. So what is the deficiency over here? How much is the deficiency? Deficiency is guaranteed profit, that is 15,000 minus 5,000. So deficiency over here is 10,000. Now this deficiency of 10,000, this deficiency of the 10,000 will be given by P to firm. Okay, so now, so when the P is giving it to firm, what are we supposed to do? Let us prepare a profit and loss appropriation account. Okay, prepare a format of profit and loss appropriation account. Okay, debit credit. Now see here, so by profit and loss account, this is your net profit. How much was the net profit? Net profit is 5,000. This is actual profit, correct? Now what is the guarantee given by P to firm? That profit will be 15,000. So how much is the deficiency? 10,000. Now this deficiency of 10,000 has to be given by P to firm. So this deficiency, so something given to firm from partners. So what is the journal entry for this deficiency? Journal entry here is P's capital account debit, because see, we have to take this from the partner, so capital account will be debited. Now when I say capital account, in this case it is capital account. If it's a fixed method, then current account. Okay, you always remember that. To P&L appropriation account, 10,000. So here in P&L appropriation account we are crediting, so by P's capital account 10,000. So after this what you do? This is 15,000, 15,000, then to profit transferred to partners capital. So two partners are who? P and Q, right? Yes, P and Q. So their profit sharing ratio is equal. So this 15,000 will be distributed equally. That is 7,500, 7,500. So journal entry for this will be your, so this is the first journal entry for deficiency. Second journal entry for distribution of profit. So that journal entry will be P&L, same. We have already done this entry, right? P&L appropriation account debit 15,000 to P's capital account 7,500 to Q's capital account 7,500. Okay, so now remember, whenever there is a deficiency, okay, from partner to firm, that time we follow this accounting method and we adjust it in profit and loss appropriation account directly. Okay. So partner to firm adjust in profit and loss appropriation account. Okay, through what? Through partners capital or current account. Is this clear? Now let us go to case 2 here. Okay, partner to partner. Okay, so PQR are the partners in the firm and their profit sharing ratio is 3:2:1. P is guaranteed by Q. So who is guaranteed here? P is guaranteed by Q. So Q has given guarantee to P that his share will be minimum profit of 12,000. So his share of profit will be minimum of 12,000. Profit of the firm was 18,000, and there you have to learn, because see, usually in exams you won't have to prepare it using both the methods of accounting. So this method 1 and method 2 are methods of accounting. Okay, so method 1 is you will be adjusting it in profit and loss appropriation account the way we have done it, okay, in the previous example. Or method 2 is pass an adjustment entry through capital or current account. So that we will learn it. In exam they will ask you only one method, any method of accounting. You have to follow that particular method. Okay, by both the methods your net result is same. Understand that. So calculation is different, accounting is different. So calculation also it's easy, right? So now see here, what is the profit of the firm? So this is a firm, and your profit sharing ratio of partners is 3:2:1. And how much is the profit? 18,000. Now this 18,000 will be distributed among P, Q and R in the ratio of 3:2:1. So P will get 18,000 into 3/6. Q will get 18,000 into 2/6, and R will get 18,000 into 1/6. Correct? So if you calculate, this is 3,000, 6,000 and 9,000. Now see here, Q is guaranteed a P is guaranteed by Q. So P is guaranteed a profit over here by Q, correct? So how much is the P's guaranteed profit? 12,000. But his actual profit is only 9,000. So there is a deficiency. So let us calculate deficiency of P. Read the words carefully. P is guaranteed by Q means Q has guaranteed P. Okay, don't get confused over here. So deficiency of P will be guaranteed profit is 12,000 minus actual profit of 9,000. So 3,000. Now who has given this guarantee? Q. So this guaranteed profit will be given by Q to P. Okay. Now let us understand two methods of accounting. So let me first do method 1. So in method 1 I will be preparing profit and loss appropriation account. So here draw the format of profit and loss appropriation account. See here we are just doing the example, that is the reason I am not drawing that complete format of profit and loss appropriation. Okay. Okay. So here profit and loss appropriation account. So by P&L account, on credit side you have a net profit. How much is the net profit over here? 80,000. 18,000, correct? So now how will you adjust this? See, 18,000 over here and distribute it to the partners. So to profit distributed to partners capital. Okay, so what I will do is I will make an adjustment in profit and loss appropriation account only. So I will just write how much belongs to P, Q and how much belongs to R. I'll leave some line in between. So initial profit is 9,000, 6,000 and 3,000. So 9,000, 6,000 and 3,000 is the initial profit, correct? Let me just extend this. Okay, now what is happening? See, now P is having a deficiency of 3,000 which has to be given by Q. So what I will do, I will add this deficiency to P. How much? 3,000. It has to be given by whom? By Q. So less P's deficiency. So Q will give this deficiency from his or her profit. So how much is the net profit now, net result here? So P will get 12,000, Q will get 3,000, and R has not given any guarantee to anyone, so R's profit remain same. So if you see the total over here, you get 12 plus 3, 18,000. So this is the adjustment in profit and loss account. This is method 1. Did you understand this? Okay. Now let us learn method 2. Method 2 of accounting. So in method 2 of accounting, what is done is adjustment through capital or current account. Now understand this. So what we are assuming over here is, see, profit and loss appropriation account has already been closed. Okay. So what we are assuming over here is ki in this method we assume that it is to be noted that your profit, okay, P&L appropriation is closed by distributing profit to partners in pre-SR, that is profit sharing ratio. Okay, this is very important. So this should be noted. In this method, we are assuming that profit and loss appropriation is already closed, and whatever was the decided PSR, that much profit is distributed to each and every partner. But after that we got to know that there is a deficiency. So if the profit and loss appropriation account is already closed, there is no point in opening it again. So now what we will do is, we will be making some adjustment entries through their partners capital or current account in such a way that net effect will be similar to method 1. Okay, now see here in our example what has happened, Q and P. So Q had given a guarantee to P, okay, that the profit will be how much, 12,000, but P's profit was 9,000, so deficiency was 3,000. So this deficiency is supposed to be given by Q to P. Now here is the firm, okay, I am firm and I am a mediator. Okay, so what I'll do is, I will take 3,000 from Q and then give it to P. Okay, as a firm I am taking 3,000 from Q and giving it to P. But see, I won't be taking the actual cash from Q and then giving the cash to P. I won't do that. I will directly adjust it through the capital account. Now see, as a firm, if I have to take something from the partner, I have to take it from the Q, correct? If I have to take something from the partner, I will debit that partner's capital account. So journal entry in this case will be Q's capital account debit. So I am taking it from Q and giving it to P. So P, I am giving something to the partner. Firm giving something to the partner means credit capital account. So to P's capital account. It can be capital account or current account also. Okay, did you understand this journal entry?
Yes, ma'am.
Sure, doubt? What happened?
No doubts.
No doubts, right? See, first method was a direct method wherein profit and loss appropriation account is not closed and we are giving the profit directly by adjusting it in the profit and loss appropriation account only, deficiency. But in second method, what we are doing, it is like profit and loss appropriation is closed, profit is distributed to the partners, and then we got to know that there is a deficiency. then in that case what we do is we adjust it through their capital account. So this is the logic of this entry, that firm, as a firm I will act as a mediator. I take it from one partner, give it to the other partner. Now let me just show you the net effect over here. So let me just prepare a rough partners capital account over here. So partners capital account. Okay, so this is a rough partners capital account, PQR. Now in this method what am I assuming? That my original profit was distributed as per their PSR. So when I distribute it to partners capital account, it would have come on the credit side of partners capital. So by P&L appropriation account. Okay, now what is the original PSR and profit? We have already calculated it here, no, in our working. Let us see that. See, 9,000, 6,000 and 3,000. So 9,000, 6,000, 3,000. Let me write it over here. 9,000, 6,000 and 3,000. Okay, now after this what I have done, I have passed this entry, adjustment of the capital. This entry, let me post it. So Q's capital account is debited. So on the debit side of the Q's capital account, because of whom Q's capital account is debited? Because of P. So I will write 2P's capital account, and in Q's column I will write 3,000. Now 2P's capital account. So P's capital account is credited because of Q's capital. So by Q's capital account, did you understand how to post this? In P's column 3,000. Now this is just an extract. Let me call this as extract, okay, because there will be lot of things in the capital account. There will be opening balance, there will be closing balance, drawings, everything. We are not considering that for now. We are just calculating the net effect. Okay, to understand net effect, I have prepared this capital account. So now let us see what is the net effect here. So credit side total 9,000 plus 3,000, 12,000 in P's column. Q is 3,000 and R is 3,000. Correct? Q is 6,000 minus 3,000, 3,000, and R remains unchanged. Now if you check this, it's the same whatever you are getting over here, 12,000, 3,000 and 3,000. Here we are directly crediting it to the capital account, whereas here we have already passed the original entry of distributing the profit in PSR over here. That is the reason we are passing this adjustment entry. Did you understand?
Yes, ma'am.
So just write this. Net effect is same in method 1 and method 2. Okay, just write this method. So this is case 3. This is firm to partner. Okay, firm to partner. So in firm to partner, see, this is a firm. Okay, what has happened? See, A, B, C are partners and their profit sharing ratio is 5:4:1. So firm and their profit sharing ratio is 5:4:1. C is guaranteed a minimum profit of 50,000. So see, when nothing is mentioned that who is guaranteeing C minimum profit of 50,000, it is understood that C is guaranteed this minimum profit of 50,000 by firm. Okay, so C is given a guarantee. Any deficiency will be borne by A and B equally. Remember, so A and B, whatever deficiency is there, that deficiency will be borne by A and B equally. Okay, so A, see, if this was not given, then we would have assumed that A and B will bear the deficiency in their profit sharing ratio, that is 5:4 profit sharing ratio among A and B, if this was not given. But since this is given, that agreed ratio is given, we will be using this ratio. Now profit of the firm was 4 lakhs. We prepare P&L appropriation account and pass the adjustment entries if any. So we are going to do it by both the methods. Okay. So now let us first calculate this. How much is the profit of the firm? Profit of the firm is 4 lakhs. Okay. Now this profit of the firm is, first let us distribute it to A, B and C in the ratio of 5:4:1. So A will get 4 lakh into 5/10. You can solve it along with me, this one. 4 lakh into 4/10 B will get, and C will get 4 lakh into 1/10. Okay, so how much does this come to? 2 lakhs. This is 1,60,000 and this is 40,000. Okay, now who is given a guarantee? C is given a guarantee. So C is given a guarantee by firm. So C is given a guarantee and this guarantee is given by firm. Correct? So now let us calculate what is the C's deficiency over here. So C's deficiency. So how much guarantee was given to C? C was given a guarantee of 50,000. So 50,000 was the guarantee given, whereas the actual profit which C got is 40,000. So how much is the deficiency? 10,000. This deficiency of 10,000 is given by the firm. Firm means remaining partners. Who are remaining partners? A and B. So A and B will bear this deficiency in the ratio of 1:1. How do I know? It is given in the question. If this ratio was not given, then I would have assumed that they are sharing it in profit sharing ratio. Is this clear? Make a cloud here. If agreed ratio not given, then PSR among remaining partners. Just write this. Done till here? Should I scroll?
Yes, ma'am.
Huh. So now see here. What is happening here? A and B has to give it to C. Correct? A and B has to give it to C. So this is C. Okay? And A and B both are giving how much? 5,000 each to C. Correct? Now first method is directly we adjust it in profit and loss appropriation account. So prepare a rough profit and loss appropriation account over here and let us see how much is the profit. Profit of the firm was 4 lakh rupees. So let me just write the profit and loss appropriation on the credit side by P&L account. Don't use this for short forms. Use it as profit and loss account only. Okay, whenever you are doing it. Now, on debit side, to profit transferred to partners capital. So if nothing is given now, we will always assume that it is a fluctuating capital method. So A, B and C, just leave some lines to adjust the deficiency. And how much did we get it? Here initially 2 lakh, 1,60,000 and 40,000. So 2 lakh, 1,60,000 and 40,000. Let me just write it over here. Then 1,60,000 and 40,000. Correct? Now who has a deficiency? C has a deficiency. Now it is given by A and B. 5,000, 5,000. C got 10,000 in total. So in C's we will write add deficiency 10,000 because C is getting 10,000. From whom? From A and B. So less C's deficiency 5,000. So always write, whenever you are reducing it, write it in the bracket, otherwise you will make calculation error. Less C's deficiency 5,000. So this comes to 1,95,000. This comes to 1,55,000. And this is 50,000. So if you total, you will get 4 lakhs. Now let us go to method 2 over here. Okay, method 2. So in method 2, what are we doing? In method 2, again same thing, right? A and B are giving 5,000 each to C. Okay, but what are we going to do? As a firm, we are going to act as a mediator. So firm, what will firm do? Firm will take 5,000 from A and B. Okay, take 5,000 each and give it to C. How much? 10,000. So firm is taking, now see the entry over here, firm is taking it, correct, from A and B. So firm is taking, something is taken. So A's capital account debit 5,000, B's capital account debit 5,000 to C's capital account 10,000. It's the journal entry. Why C's capital account is credited? Given to the partner. So when firm takes something from the partner, debit capital account. When firm is giving something to the partner, credit. So in other words, when the firm's liability towards partner increases, credit. When the firm's liability towards partner decreases, debit. Now let us just prepare the extract, okay, to see the net effect. So extract of profit partner's capital account, just small partner's capital account. Okay, so first is by P&L appropriation account. Okay, how much was the initial distribution of profit? We will use that 2 lakhs, 1,60,000 and 40,000. Correct. In method 2, the assumption is that first profit is transferred and then we are adjusting the deficiency. Now see this carefully. A's capital account debit, B's capital account debit. So both the capital accounts are debited because of whom? Who's the corresponding account? C's account. So on the debit side of A and B, we will write 2 C's capital account and 5,000 in A's column, 5,000 in B's column. Now C's capital account is credited because of whom? Because of A and B. So on C's capital account credit side, by A's capital, by B's capital account. Okay, in C's column on the credit side, we will write 5,000. Now there will be lot of other entries in the capital account, but we will just see what is the net effect here. So net effect in A's, credit 2 lakh, debit 5,000. So 1,95,000. Here B's credit side is 1,60,000. This is 5,000. So 1,55,000. C is credit 40 plus 5 plus 5. So that comes to 50,000. Now if you check this net effect, 1,95,000, 1,55,000 and 50,000. This is same as method 1. Finished? Now we have finished with all the three types of guarantees. Okay, all the entries for three types of guarantee, that is partner to firm, firm to partner, and partner to partner. Now what we will do is we will see what happens when there is a loss. What happens when there is a loss? Okay, so here, see here, A, B, C are partners in the firm and their profit sharing ratio is 3:2:1. B is guaranteed a minimum profit of 1,50,000. Loss of the firm is 30,000 and we will be preparing a profit and loss appropriation account and pass the necessary adjustment entries. So let us just draw here. So this is a firm. Okay, so firm and profit sharing ratio of the partners is 3:2:1. When nothing is given, even their loss sharing ratio is same. Okay, sometimes loss sharing ratio can be different than the profit sharing ratio, but it has to be specifically mentioned in the question. So now if you see here, there is a loss of 30,000. So I will write it, either you write it in the bracket or you put it as minus. Okay, so there is a loss. Now this loss will be distributed to three partners, A, B and C. Correct? So minus 30,000 into 3/6 minus 30,000 into 2/6 minus 30,000 into 1/6. Correct? So this comes to minus 15,000. Then this comes to minus 10,000 and this is minus 5,000. Now let us see here what has happened. Who is given a guarantee? B. B is given a guarantee. So B is given a guarantee that B will have a profit of 1,50,000. Instead of that, B is incurring a loss of 10,000. So how much is the deficiency of the B? Use the same formula. Actual guaranteed profit, that is 1,50,000 minus actual profit. So minus actual profit. Instead of actual profit, you are having a loss here. So minus 10,000. So guarantee will be 1,60,000. Did you understand this? See, B is guaranteed a minimum profit of 1,50,000 by whom? Nothing is given means by firm. Okay, so this profit, this guarantee deficiency, whatever is guaranteed to B will be shared by remaining partners. Who are remaining partners over here? A and C. So is there any other ratio, agreed ratio to share this deficiency which is given in the question? No. So A and C will share it in the ratio of 3:1. Okay, so this 1,60,000 will be shared by A and C in the ratio of 3:1. So 1,60,000 is the deficiency. It will be shared by A and C, right? B is given. No? This is B, deficiency of B. Let me write it over here. A and C in their profit sharing ratio. That is 3:1. So A will be bearing 3/4 into 1,60,000 and C will be bearing 1/4 into 1,60,000. So 40,000 and this will be 1,20,000. Did you understand this? Now see here. See now whatever is the deficiency whatever is there, see it is more than their profit, correct? A doesn't have that profit to adjust it directly in profit and loss appropriation account. So in this case, whenever you have a loss, your method 1 will not work. Method 1 of accounting will not work. Okay. So in that case, what we will do, in case of loss, we will just distribute the loss in profit and loss appropriation. Okay, normal loss, whatever is the loss, you distribute it and then use method 2, that is adjust in capital or current account, because we cannot adjust in profit and loss appropriation over here, because there is no sufficient profit with A and C to adjust, correct? So how will your profit and loss appropriation account look over here? Profit and loss appropriation, see, this is a loss, so it will come on the debit side. So to P&L account, this is a net loss of 30,000, and let us distribute it by loss distributed to partners capital. Okay, we have what? A, B and C. So A, B and C, it is how much? 15,000. We calculated it, right? 10,000 and 5,000. So total comes to 30,000. So you what you do in this case is, wherein you have a loss, follow method 2 of accounting, because you cannot use method 1. There is no sufficient profit to adjust it in profit and loss appropriation account directly. So now what is the entry? What is the entry? So we have to take it from A and C and give it to B. Correct? Take it from A and C means A's capital account debit. A's capital account debit 1,20,000. C's capital account debit 40,000. 2, we have to give it to B. To B's capital account 1,60,000. Did you understand this? Why we are not able to do it using method 1?